Tutorial I'll be showing you about Tractor Supply Company. Just type it in Google and press enter and you will see the name Tractor Supply Company, and TSCO is the symbol in Nasdaq. And I just want to show you, if I buy the stock right now on 2nd of August, it will be 107.06 US dollars for one stock, and the market cap is in billions. That means it's a big size firm, and the dividend is 1.31%. I just want to explain you briefly about the dividend. If the dividend is if a company is paying dividend, that means they're financially very strong, because after paying their loans, liabilities, creditors, they still have extra money. That extra money they pay to shareholders as dividends. This firm is paying dividends. That means that it's financially very strong. So this is a positive sign. Now, let's look, when was this founded. I can see simply from Wikipedia. I can search a box here and I can see it's founded in 1938, 81 years ago. Now let's see what the employees have to say about this firm. I'll just simply copy this firm and type in Indeed reviews. Okay, and I just want to see the total reviews it has. It's 3,100 reviews and it's 3.5 star, which is brilliant for a firm. And now just read through the pros and cons yourself, the reviews yourself, and see how the firm is, how it's like working for the firm, what employees have to say, and just go through the salaries they're paying, the photos of the firm, the jobs they have listed, the question and answers, and also go to Glassdoor. That is brilliant for reviews as well. And I just want to show you something. It's just taking some time to load. Yep, so I can see we have 1300 reviews in Glassdoor, and you can see the jobs listed. You can just see the type of jobs they have listed, and the salaries they're paying, and the interview questions people are asked at interview, and the benefits they're paying to their employees, and the photos of the firm. And also I just want to see. Sorry, 1 second, it's just taking time to load. Okay, I can see 1300 reviews in Glassdoor and it's 3.1 star. And just go through the pros and cons yourself, what people have to say about it. Now let's go to Yahoo Finance, and I want to see the key executives and their salaries, and just paste it in here. And this is the symbol we're looking at. If you are confused about which one to click, just simply go to Google and click enter. You can see the Nasdaq symbol, which is TSCO, so click that one. So I'll just go back and I'll click this one and go to profile, and let's have a look. Go to sector, industry, full-time employees. That's the thing. And the best part is that we have 5 key executives. All of their salaries have been shown. That's brilliant, because they haven't hidden anything from us in terms of salaries. So it helps us build trust with the firm, which is brilliant. Let's go to Gesture Patent and see if this firm has any patents. So I'll just click there. I'll go to sorry, I don't know what's wrong with the internet today. It's taking time to load, so please bear with me. Let's go to this in search bar. And I just want to point out that please don't consider it inventors. Inventors are people who invented but they don't have full rights. I'm just interested in assignee or applicant, because these are people who have full rights. So we can see in 2015 it has patent, 2017 which is a recent patent, 2015, 2013, 13, and so on. So it's a big list. That's brilliant, because the more patent a firm has, the more better it is, the more stronger it is. And just be careful, this is some other firm, this is not the firm you're searching, so be careful with the names as well, that you are looking at the right thing. And if it has recent patents in 2015, 16, 17, 18, that's brilliant, because it means it's still innovating, still trying to beat the competition. So that's brilliant. It has a patent in 2017, so that's brilliant, that's a recent patent. And go through the list yourself. Now let's go to macro trend, and I want to see the ratios. Go to price ratio and price book ratio and paste in the symbol that you can get from Google. And now I just want to explain you briefly that if price book ratio is less than 1, that means that the stock is cheap, it's undervalued, it's at discount, it's a sale, you must buy it. If it's more than 1, that means stock is expensive. The higher the number goes, the more expensive the stock gets. So let's see. Please bear with this website, because sometimes it takes a lot of time to load, but don't mind, because there's a lot of data in this website. So once it's loaded, it will make your life quite easy. So just be patient with this website. Okay, so it's just loading. Please let me know if you want me to explain something further or in detail, or if you're stuck somewhere, or I'm just rushing through the tutorial, you want me to slow down. Please let me know. Right now it's 8.7, which means the stock is 8.7 times more expensive to buy right now in August 2019. If I just see that in 2016 March it's 8.53, which means that people who bought in 2016 March, they bought it 8.53 times more expensive. So they bought the stock, they paid $86 to buy something that was $10 worth. So they bought it 8.5 times more expensive in 2016 March. Right now it's 8.7 times more expensive. But if I see in 2008 June, it's 1.65, which means that the stock was 1.65 times more expensive. So people who bought that time, they paid $6.6 to buy something that was $3.99 worth. So it was a little bit more expensive, but still it was expensive. But right now, it's 8 times more expensive, nearly 9 times. So you need to be careful if you want to buy right now when it's very expensive, even if the stock is doing very good. But still, you need to maybe you need to wait for a while for it to come down and then buy it, because even if the thing is good, you don't buy it when it's expensive. So it's up to you to decide. Let's go to other ratios and current ratio. If the current ratio is less than 1, that means that stock is very dangerous, it's risky, and because the liabilities are more than assets. If it's 1.5 or more than that, that means stock is safe. It has a good margin of safety. So let's have a look once it's loaded. Okay, so let's have a look. Right now it's 1.5. It's a brilliant thing because the stock is very, very safe. Let's look at the previous ones. Has it ever been below 1.5? Yes, just once in 1.49. That's just one, and it's a little bit below 1.5. That's fine. So since we have data since 2005 up till now, since recent 14 years, it has always been 1.5 or more than that. That means stock is very, very safe. That's brilliant. We have good margin of safety. Let's go to debt equity ratio. This ratio will tell me if the stock is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that for it to be brilliant. Let's have a look. Okay, so it's more than zero point 0.5, so it's a dangerous stock. And if you have a look that the debt is 1.57 times the equity, which is a lot of debt. It's more than equity, so the company is mainly operating on debt, which is dangerous. Let's look at the previous one. It's 1.73. That's a lot dangerous. The company is mainly operating on debt. Let's go down. Yes, it's less than zero point 0.5, and then just once a little bit more than zero point 0.5. So I can see that since we have data since 2005 up till 2018 December, it's always been zero point 0.5 or less than that. So it's a safe stock. But since 2019 March, it's a dangerous stock because it's more than zero point 0.5, and uh, right now it's more than zero point 0.5. So now it's a dangerous stock because the debt is a lot more than equity and it's more than zero point 0.5. So we don't have a margin of safety in terms of debt equity. Let's look at the final ratio, which is return on equity. I'm looking for 8% and more than that for it to be brilliant. Let's have a look. Okay, so you can see we have more than 8% equity. That's brilliant. Let's look at the previous one. Is it always more than 8%? Yes, since 2005 up till now, since recent 14 years, it's always been 8% or more than that. That's brilliant equity.